Well, it's July 27th, and welcome to this edition of the Risk Shadow Podcast. It was a really exciting day today in the markets. We've got a lot to talk about: stocks, bonds, currency, precious metals, and some other interesting related issues. So hang on. This episode of the Risk Shadow Podcast is sponsored by the Shadow Beverage Group, makers of Dude Vodka, the best value vodka in America, Mist Vodka, the best premium vodka in America, and Mist Tequila, absolutely the best tequilas in the world. You can find us at www.shadowbeverage.com. Well, let's get right to it. Needless to say, today was a very exciting day in the stock market. The Dow was down 198 points, a little over 1.5%. NASDAQ was an overachiever. It was down almost 2 2/3 points. It was down 75 points overall. And the S&P 500 was down 2%, and it was down 27 points on the day. Closing level on the S&P was 1304. Closing level on the Dow was 12,302. We had a yield on the 10-year Treasury bill that was basically hovering right around 3%. Gold was up at 617, and the U.S. dollar was absolutely getting the crap kicked out of it all day long. The big issue here is the fact that no matter how we look at this, the people in Washington can make any kind of excuses they want. It doesn't matter which party they are, but they just can't seem to accomplish anything. And so that's one of the big issues here, is just the fact that we are not getting anything out of our people in Washington. There's a real crisis, a total lack of leadership, and it's showing up in how the U.S. dollar is getting literally the crap kicked out of it. Anybody who's been following our work for even a short period of time knows that we were the people who originally invented the phrase and coined the phrase and created the concept of the currency wars. And the currency wars are basically what happens when the U.S. dollar has to go toe-to-toe on an exchange-rated basis between different currencies. And the bottom line is, the worse the economic policy, the worse the administration, what happens is the U.S. dollar just literally loses 8 ways to Sunday. And the U.S. dollar has been losing every one of the currency wars that it's been dealing with for quite some time. However, that doesn't mean that you can't make money. You can make a lot of money. And if you're smart and you listen to what we're telling people to do, you can do this on a very risk-averse basis. The classic example is we have been putting people into Australian one-year Treasury bills. The reason is because we've been getting yields. If we go back just recently to some levels, we've been getting yields above the 470 level. Treasury bills now, Australian Treasury bills are down at 4.5. And you realize that this is a 4.5% yield on a one-year Treasury bill. Right now, you can't even get that on a U.S. 30-year Treasury bond. So are there ways to make money on this? Absolutely. Do you have to live with inferior rate of returns off your passbook savings, off your money market funds? Absolutely not. You can buy these Australian one-year Treasury bills through just about anybody. If you've got a decent brokerage firm or even an online firm, you can do this. You can even buy it through some of our sponsors, actually. But the thing that's important is the fact that when we originally wrote the concept of the currency wars, one of the big forecasts that we did going back some time was we wrote the forecast for the fact that the Australian, the Aussie dollar, as it's called, would basically come and pass parity with the U.S. dollar. And a lot of people found that very, very hard to deal with. It didn't fit into their political preconceived bias about the investment world. And that's one of the reasons that a lot of money managers, including George Soros and many other people, can't seem to make any money in this environment, especially over the last few years, is because it's their political bias that affects their ability to make rational decisions, and that's why they lose money. So when we sit down and take a look at this, one of the big issues that starts to pop up is the fact that if we just go back to late 2008, 2009, when we wrote the original forecast, the Australian dollar was basically trading well below 65 cents on the dollar. We told everybody that it would come to parity within about 24 to 36 months. Lo and behold, the last time that it traded down below 65 cents on the dollar, it traded to 63.89 March 2nd of 2009. That should be a familiar date to a lot of people. And since then, this thing has just plowed its way forward. It broke through parity for the first time in late November of last year. We told everyone that in hard copy. You got to remember that we write our forecasts in hard copy, which is one of the reasons I write for the Examiner and other people. We put this out there for God and everybody to see, and we put it in black and white. Like I like to tell people is, listen, if I can put it on paper, you know what? Basically, you're screwed, because that's what's going to happen. Well, the deal was the Australian dollar, which we forecast to go through and test the 110 level, came back and basically broke out through 110 way back in May. But the interesting thing is that today, the Australian dollar, lo and behold, mystical, magical, closed above 110. It closed at 110.33. Now, the thing is the fact that there's all kinds of volatility in this market, but if you had been buying Australian one-year Treasury bills, you would have paid 65 cents on the dollar if you'd have bought them in 2009. Today, that same Treasury bill, regardless of the yield, was worth $1.10 in the US dollar. So the bottom line is the fact that you got a massive move in the actual physical value of your Australian dollars. This was the single safest currency play available on this planet. The only thing better was Swiss franc, which of course we wrote a huge report on almost about at the same time, talking about the strength of the Swiss franc. This is a really big deal, because what people don't understand is the Australian dollar is not done going up. The Australian dollar has a lot more potential on the upside. So when we talk about safe ways to make money by investing in other currencies, trust me, you're getting right now a 4.5% yield on a one-year Treasury bill, and you're getting the currency appreciation on that Treasury bill as well. The other thing that we want to talk about today, as long as we're talking about currencies, let's go back and talk about our friend the Swiss franc. The Swiss franc, which has been absolutely a marvel to a lot of people, because they did not perceive the fact that the Swiss franc was in a position to benefit from the currency wars. They are basically dealing with the fact now that if we go back and we go back to the period of, in essence, late 2006, as an example, we warned people in 2006 that basically the thing is that the Swiss franc was on the march, and that the dollar was basically going to fall, and the dollar would fall dramatically, and that Swiss franc would rally dramatically. So if you had been short Swiss franc from late October of 2006, when it was trading at 127 to the dollar, the bottom line is that today you would be looking at the fact that it's currently today trading at 80.14, which means basically your dollar is only worth 80 cents to one Swiss franc. Before it was worth 127 to the Swiss franc. So the bottom line is the fact that the dollar has just gotten hammered over and over and over. The Swiss franc has been a wonderful market to trade. It's had very good trending and technical characteristics, and the bottom line is, of course, needless to say, it messes up the mind of the politicians, and in particular the pinheads in the business, entertainment, journalism world, who have to write their stories based on the political bias of their editors and their magazines and this type of thing, which, needless to say, when you have a proprietary technical system, you don't have to do that, especially after 30 years of being right. It helps make your life a little bit easier. So one of the things is, and we wrote a very big forecast on this before, is the fact that the Swiss franc is not anywhere near being done in terms of its ability to appreciate against the dollar. The thing here is the fact that we've had some really exciting moves in the Swiss franc, and the bottom line is the fact that what we're going to be looking at is that in the near term, last night as an example, we got down to 79.95 on the Swiss franc. There are going to be rebounds and this type of thing, but the bottom line is long term, the major trend is down, the mega trend is down, the major trend is down, and the near term trend is basically a little bit choppy, but it all works to the downside. The funny part is there's a lot of quote unquote big forex firms out there that guys like Daily FX and DBFX and some of these other people who just basically just don't have a clue what's really going on in the world, and basically that's why they're in the churn 'em and burn 'em business, as they say. They don't understand the fact that the Swiss franc has got a long way to go here. So basically the next stop for the Swiss franc on the downside, you can pretty much bet that it's going to be running down to test somewhere in the neighborhood of the level of around 75.5 to 75. There's going to be a significant bounce down there, and there's going to be a continued decline of the dollar. So don't be surprised if you see moves beyond 75 here before the end of the year. So that's one of the big things that you want to think about as well. Japanese yen has basically been tearing up the dollar something fierce. We are looking at the fact that we closed today with a 77 handle on the Japanese yen to the dollar. which is indicative, again, of the fact that, isn't it really interesting that here we have the Japanese yen and the Swiss franc both locked into the same long-term trends against the dollar, where the dollar is failing and they're appreciating. And the thing that's really interesting is the fact that right now the Japanese yen is running a little ahead of the Swiss franc, but the point is the fact that you're going to be surprised to see that maybe the Swiss franc will catch up and trade almost at the same level that the Swiss franc, the Swiss franc will catch up and trade at almost the same level that the yen is trading to the dollar at. One of the things that we talked to a lot of people about is the fact that when we talked about the euro dollar, we talked about the sterling coming to parity. That means that what happens is they will come to parity with each other, and then what happens is the fact that the trading rate that they have to the dollar will be identical. And then as the euro dollar fails, what starts to happen is the euro dollar will start to come to parity with the dollar. But that's going to be a much harder trend to ride, because the bottom line is the United States is basically shooting itself in the foot. So the euro dollar has the ability to move against the dollar, and then the euro dollar has the ability to fail against the dollar, which makes this all very interesting. So you have to really stay on your toes. That's something that for people who are seriously active traders. The bottom line is the fact that in some of these major currencies, like the Swiss franc, like the Japanese yen, like the Australian dollar, and the pound sterling, these are all in a situation to take advantage of the collapse and decline of the dollar that's being given to us by the supermajority Democratic Congress and the current White House. So you can just expect the fact that these are basically trends that are going to be very, very hard for the U.S. dollar to fight, and that's basically because the fact that, like in most of the wars lately, the single greatest handicap that the Americans have is their own government. So, stay on top of that and stay tuned, and we'll start to talk about stocks here in just a minute. Well, let's talk about the major source of grief for most of America, and that's basically how the stock market's been behaving. We've tried to explain to people over and over and over that basically the American equities market, regardless of whether it's NASDAQ, S&P 500, Dow, the Russell 2000, basically it is caught in a web of, let's say, mush that's been created by the Congress, current economic policy, excessive spending, and real problems with the Treasury and monetary policy. The reality is the fact that what you've been looking at as an example is the fact that people still don't seem to understand that the major trend for the stock market is still long-term down. You're trapped in what is the largest bear market in history. It's not anywhere over. The bounce in 2009, the proverbial dead cat bounce, basically all that's happened is that QE2, the jawboning and the phony data that's been kicked out by the administration and by the federal government was created strictly to try and create the perception of a perceived recovery, which there never was one, period. The thing is the fact that the greatest scandal and shame in this country is the way that they are trying to hide and disavow responsibility for the massive amount of unemployment. The federal government has turned into one of the greatest job-killing machines in history. And now what's happened is the fact that I think if you did some analysis right now and you did it honestly and you looked at it from 2007 forward, you would be able to actually make the case for the fact that the real unemployment rate in this country right now is somewhere between 25 and 30%. And most of these are people who became unemployed starting with the collapse in 2007, lost their benefits, so they vanished off the radar screen, have never gotten another job. And as we saw this week, there was a very interesting article this week talking about the fact that many people like Monster and other people who have online jobs are telling people, if you're currently unemployed, you know what, employers do not want to take your resume. They're only interested in talking to you if you happen to be currently employed. They don't want to talk to currently unemployed people. So what's happening is the fact that the quote-unquote great recovery is really the jobless, penniless, homeless recovery. And the deal here is that the Obama administration is making the same mistakes that FDR made, which is FDR wanted to raise taxes in the middle of the Depression, which made it worse. The difference is that FDR, the patron saint of all liberals and Democrats, however, did not destroy the dollar. Basically, what's happening is the fact that the supermajority in Congress is basically finding a way to ruin the country, ruin the currency, kill the economy, and basically make everyone into part of the massive army of unemployed. When we look at this on a technical level, there's some very interesting issues, as an example, with the S&P 500 that we need to talk about. And one of those is the fact that in any pure technical model, the bottom line is, you know what? People can say anything they want, they can do anything they want, but everything is reflected in the physical price that things trade at. So the bottom line is the fact that you can have people, idiots like the Associated Press, who basically are nothing more than the propaganda machine of Wall Street, cranking out any piece of baloney that's basically wrapped in blue sky to try and make you think everything is fine and wonderful. But the reality is the fact that the market itself has never broken out of the whole technical profile of a failing market. People need to understand the fact that the great bull market for America, and I'm not talking stocks, I'm talking the growth cycle for America, ended in the year 2000. We wrote the forecast for the end of the bull market to be in January of 2000, and when it happened, and we ran around screaming and yelling at people and giving them all of the data and all the proof that the market was over as of the first week of January in 2000, they just couldn't cope with it. The other thing is the fact that basically the market moving from 2003 to 2007 was nothing more than basically all it was the perfect bear trap to set people into. And you can thank Wall Street and everybody else who basically managed a way to keep selling you securities at the higher and higher and higher levels, because the bottom line is, in essence, Wall Street was shorting their positions into your face and selling you worthless equities, which is one of the reasons that we had the real estate debacle. But over the last several months, the bottom line is all that's happened is the fact that we've had a bounce at the March low, which was the first low on the way down, which was up against the previous lows of 2003. And the thing is the fact that now, as the market moves forward in time, it only has a certain amount of time to accomplish certain tasks. And the bottom line is all of the tasks that it would need to accomplish to break out of this massive bear market cycle, it's failing at over and over and over. So the thing that's interesting is if we go back to the low that was made earlier this year, which was up against 1256 in March, that basically at the time was up against what was an existing 200-day moving average. The bottom line is when the market came back out and made another low, the bottom line is it again was up against the 200-day moving average. I don't like moving averages. I find it very coincidental, though, that in this case what happens is that both of these lows bounced off that 200-day average, which is extremely negative. The more times that something trades down to a certain price, the weaker the market is. The problem is what we're looking at is a massive distribution pattern, which was basically based off the move that the Fed made to try and goose the market. All QE2 did was basically provide a way to cantilever this failure forward and make it so that what happens is that the failure of the economy itself is a more extended and protracted failure. There are no solutions here. There's just more debt. So what's happening is the fact that you're building this massive, massive right-hand shoulder, and the bottom line is the fact that right now, if we take a look at the June 28th low in 2010, which is 1022, and we take a look at what the 50% retracement level would be on a move up from the March low to the April 25 high at 1363, that comes back in at about 1,000. The thing that's really fascinating here is the fact that if we look at the range for the year of 2010, we come in with a 50% level at 1142. What this means is the fact that what people don't seem to understand is the distribution process is actually Wall Street unloading its positions to the small guy, unloading its positions to the small investor. If they didn't have you to dump their positions on, they would have no way to get out of their positions, no way to unload their phony equities, their phony IPOs, and this other stuff. So what's happening now is the fact that as of today, which is the worst day in 8 weeks, it is the second worst down day in 2011. But the more important thing is the fact that basically what happens now is the fact that the only support that's actually really below the market now is down at 1268 in the near term. That is the bottom of the near-term distribution range. This is a big deal because what happens is the fact that once we break back down to that level at 1268, the bottom line is you're running up against what is, in essence, quote-unquote, the same level that the market opened at in January. In other words, it will have given back 100% of its gains that it has acquired for this point in time when it breaks that level, what it's doing is it's building up a run to drop down basically what is down to the 1,022 to 1,042 ballpark, and I would say more likely it's giving a chance to run back down to the 1,000 level. The point is when it gets there, people will think, oh, gee, look at this. The market will suddenly stop. It will bounce. They will not understand the reason. All of the clowns on Wall Street, all the clowns in the New York media will come up and invent some crazy-ass excuse. And the reality is all it will do is it will stop at the 50% retracement level to have a bounce. The issue is the fact that what they don't seem to understand is that they will already be into the next great super wave that is setting the market up to decline. That is something that people just can't seem to cope with. Now, on the flip side of this, you're talking or listening to the same gentleman who a year ago, last June, forecast that Apple stock would just never, ever seem to go down, that it would go to 350, it would go past 350 within 12 to 24 months, and then it would head for 550. Lo and behold, this week, we're trading at over $400 a share. The joke is that we have now revised up our long-term estimate on Apple to as high as 850, provided Apple does not pull off a stock split, which I think is a highly possible situation, especially once the stock gets to something in the neighborhood of around $600 a share. I think a stock split is highly likely, and it would probably be like a 2-for-1 split, maybe a little more. But the reality is there are stocks out there to like. The problem is there are very few. There's a lot of investment money managers who say, oh, I can't buy Apple stock. It's overpriced. I'm like, well, listen, you know what? You had a chance to buy that stock a long time ago at very cheap levels, and you refused to do it then. There are certain companies in this country that are going to do extremely well because virtually 90% of their business is outside the United States, and their growth market for everything is outside the United States. The U.S. government, your congressman, your senator, and everyone has made it very clear to business to ship all of the jobs that America had for manufacturing and everything else, to ship them offshore. Once they're gone, they don't come back. That's one of the big issues. That's why the stock market's having part of its problems, is also because retail sales, without retail sales, you can't have earnings, and the margins are getting smaller and smaller. So this is one of the reasons why basically what's happening here is the government is helping to kill the stock market. Whether they want to admit that or not, that's a whole other issue. But the deal is that most of these companies have laid off as many people as they can lay off. They've fired as many people as they can fire. They have streamlined their manufacturing. They have cut down their inventory. And the bottom line is the fact that retail sales and sales in general are in the tank. Now, a lot of times you'll see data that comes out related to like auto sales and other stuff, and they'll say, oh, look, it's up 20%. 20% of what? 20% of zero. The bottom line is when you lose 90 to 95% of your sales, and then all of a sudden you come back and go, look, sales are up 20%. Well, 20% of one, 20% of two. The other thing is the fact that there's a lot of numbers being bandied about that, of course, once again, all turned out to be fake. It's kind of like with the census workers. They hired him for a week, then they fired him. Then they rehired him again, and they fired him. And they rehired him again, and they fired him. And what did they do? They claim they created 3 jobs for each census worker that was out there because they hired him and fired him over and over just so they could appear to create jobs. There have been a lot of scandals popping up in terms of how the government is doing a lot of things, but right now what you have to understand is that the business environment is extremely negative, and people are going to have to fight much harder for the customers they get. They're going to have much thinner margins, and people are going to have to be very self-conscious. The other thing is the fact that people are cutting down on debt. Corporations have to cut down on debt. The problem is we have to get the government to cut down on debt, which is a whole other issue. So when we take a look at the S&P, we look at the NASDAQ, we look at the Dow, there really is no happy ending here for the stock market. It's just not going to get better. Basically what it is, it's not a matter of if it will go down, it's just a matter of how out of control or how protracted the decline gets, because basically governments are in the business of trying to pretend that they're doing you a favor, and right now the bottom line is it's very hard for them to sell that myth to somebody. But that's what you need to look at with stocks. If you've got profits in stocks, the reality is that you bought into the market at a specific level. If you bought into the market in the area between 1,000 and 1,200, the bottom line is you still will have the ability to basically get out of your stocks without, in theory, a loss. If you have bought into the market above 1,200 and you are not getting out now, and you do not get out as the market makes this decline and breaks back below the 1305 level, breaks back below 12,000 on the Dow, the bottom line is you're going to be trapped in your stocks. You're going to be trapped in your mutual funds. So the reality is the fact that you need to take a long, hard look at your share value price. If you have or are very near your break-even point, the bottom line is you get out of your stock now to avoid the problem. If you own stocks from a dramatically lower level, the bottom line is you sell a covered call, you retain ownership of the stock, you book the profit, you covered the call when the market gets down, and then you keep your stock in hand that you have for much lower price levels. The bottom line here is you have to do the things that decrease risk for you, not decrease risk for Wall Street. The most important thing you can do is remember to sell stock and book your profits when you have them. So let's move on and we'll talk about the Treasury market. Okay, U.S. Treasury market. This week is an auction week. Today we had the auction of the 5-year Treasury, which went as a dog. The thing now is the fact that what people need to understand is there are all kinds of things happening in the U.S. Treasury market, none of them positive. A classic example is the fact that the U.S. 13-week Treasury bill is in a situation where it is giving us all the indications that it is going to have dramatic rise in yield. This is going to be tied, in essence, into the fact that people are looking to roll out of U.S. Treasuries. The way that they're going to do that is all they have to do is let their Treasury bills mature, take their money, and take that money and move it into some other currency, which means they can buy a different stock market, they can buy different bonds, they can buy gold, they can buy silver. And the deal is the fact that what's going to happen here is you're going to start to see a shift, and there's going to be volatility in the Treasury bill market, but the Treasury bill market is getting ready to pop to dramatically higher yields. I know it's very hard for people to understand this, but it was only recently that we were at a yield of 0.005 on the 13-week Treasury bill. Today we're at a 0.07 yield, which is a dramatic increase. The 5-year Treasury right now is trading at a 152. The 30-year Treasury bond, of course, which we highlighted when we talked about the Australian Treasury bills, is trading at a 428. And everything about Treasuries is related to the yield over duration. We're looking at a 10-year Treasury that's trading at a 298 right now. What's happening here is the fact that the Treasury market looks terrible. It feels terrible. Technically, it trades terrible. And the reality is here is the fact that while if we had a massive sell-off in stocks and people jumped out of stocks and went into bonds and bond funds, the majority of those would be purchases made actually in durations under 5 years. You would see a lot of people buying the 2-year and 3-year. Tomorrow we have the 7-year Treasury. Usually that goes well, and that's normally an issue that has pretty good participation from foreign buyers. It'll be interesting to see how many foreign buyers there are, but the bottom line is the percentage of foreign buyers in the Treasury auctions has been decreasing, which is another example of people saying, hey, look, I'm just going to let my money mature. A lot of Americans don't understand that foreign investors, they have these different issues, even regardless of what the duration is, whether it's a 2-year, 3-year, 5-year, 10-year. They have these things laddered. So every month they have some 10 years roll over, some 7 years roll over. All these people have to do is allow those to mature and then put the money into something else. And instantly, all of a sudden, there is a selling effect into the market, because the bottom line is when these people don't roll their money over, they're not buying any new issues. The Treasury is planning to play the game that, well, we're not reissuing any debt. We're just rolling over existing debt. The problem is that as they do that, the deal is the people do not bid aggressively on these items. People bid on yield. They just don't blindly buy these things. So what happens is people start to fade their bid. Instead of bidding 150, they bid 155, 160, 175, 180. It would not be at all surprising to see the Treasury bills pop as much as 50 to 60 basis points in the very near term, only because of the problems that are coming out of this entire debt ceiling debacle. So what we need to look for is the fact that we could very easily have an inverted yield curve, which occurred under Alan Greenspan, by the way, which was one of the problems that Alan Greenspan created for us and gave us, which has led to some of the other problems that we've had. But the deal is that an inverted yield curve means that short-term rates start to get higher and higher. Eventually what happens is the fact that the yield curve itself starts to snap and move. Then what happens is the rest of the yield curve moves, and you get a very quote-unquote positive yield curve, because all of a sudden yields on the back end of the curve go way up. A lot of people will tell you that a positive yield curve is very encouraging for growth. The problem is the fact that in this scenario, the positive yield curve will mean that the spread between the 30-year and the 5-year will get wider and wider and wider, not because of a good thing, but because of a bad thing. It will mean that people are dumping long-term treasuries, moving into short-term treasuries, and putting pressure into the middle or front end of the curve. At the same time, you're going to be looking at the fact that treasury bills are going to be something that people just can't deal with, because the bottom line is they can't face owning treasury bills at a 0.07, especially when they can own treasury bills in another currency and get 10 to 20 times the yield that U.S. Treasury bills are giving them now. So what starts to happen is all of a sudden these things pop. I remind people that in 1987, and I was the guy and the only guy who put out a hard copy forecast months and months and months before the market even made its high. But I put out the forecast for the 87 crash in writing, in black and white. It came out through Telerate, Cantor Fitzgerald, and everybody else. The bottom line is the fact that we ended up with a yield on treasury bills of 14%, one-year treasury bills. That is not indicative of somebody who's having something go right. So what we need to look at here is the fact that if you're looking at being invested in fixed income treasuries, I highly suggest that you do not invest in U.S. Treasury bonds or treasury bills, because this is absolutely the wrong time to be in that market. Let's move on, and we will talk about precious metals. Okay, gold, silver, copper, platinum, palladium, all of these precious metals are basically pretty much giving a lot of people grief, because the bottom line is they would just love to be able to come out and say, oh, it's time to go short gold, it's time to go short silver. The bottom line here is that the mega trend for precious metals is up, and it's not going down anytime soon. Yes, you will have certain types of consolidation and corrections in these metals markets, but the reality is, let's get back to what we were saying here before. Recently, a lot of people were all over the fact that the silver market sold off. The silver market sold off not because of a fundamental reason or because of a price reason. The silver market sold off and the gold market sold off because basically the NYMEX, Chicago Board of Trade, CME, everybody raised the margins on these contracts. And in the case of silver, I think they raised the margin 8 times within a 5-day period. They did so basically to try and push small investors out of the futures and options market, because these people wanted to take delivery of their precious metals. So today we're out there at $1,617 on gold. We're out there at over $40 on silver. We had a little bit of a pullback today, actually a fairly decent pullback in palladium, which will set up a good buying situation. And platinum is down at $17.94. Copper is up at $4.44. People don't seem to understand the fact that all of these hard commodities, especially any of the metals, are locked into this long-term super cycle. And part of the reason that it's happening is you can look squarely at Washington, you can look squarely at the Federal Reserve and Ben Bernanke and Treasury Secretary Geithner, at the fact that their policies have basically destroyed the value of the dollar. And that is part of the reason why precious metals in dollar denominations are going up so dramatically. It's not that they're not going up other places, but they're not going up with anywhere the kind of strength that you see in a dollar denominated situation, because the dollar is collapsing. And what people have to understand, it's not that gold is overvalued or silver is overvalued, it's the fact that the dollar is collapsing. I actually used an article this week of a roll of $1 bills hanging on a toilet paper dispenser. And that's basically what's happening to the dollar. And you get to thank your government, your senators and your congressmen, your state legislature and everybody else, but particularly you get to contact the people at the Fed and the Treasury for basically going out of their way to basically kill the dollar. This has strategic consequences that benefit the federal government, because they don't want you spending your money on products, goods, and services that are coming from out of the country. And they want to find a way to keep that money in the country. I actually believe that what they'd like to do is to destroy the currency and change everything over into electronic currency units, so that what happens is they could basically make it impossible for you to pay cash for anything. You're dealing with a mentality in the federal government on multiple levels that basically wants to turn the country into kind of almost a police state related to how they control commodities, money, and everything else. This is why I keep recommending to people that they read the book called The Road to Serfdom, written by F.A. Hayek. And that's something that will tell you and explain to you the policy of what's happening in the federal government is to try and take control of every single resource and everything and manipulate it to the benefit of the federal government. So precious metals, short term possibly for a correction. The long term is you're going to continue to get more reason to buy it. You're going to get more reason to see these metals go higher. And I had to laugh because out there on Yahoo today, Yahoo carries all kinds of crazy commentary from all kinds of people. There was actually a guy that popped out of the woodwork today and said, you know what, I think gold might go to over $1,700 an ounce. My question is, where was this moron 6 years ago? You got to remember that our work publicly, we've been putting out advisory on the great bull market for metals since gold was trading in the 3s and 4s and 5s. I mean, the deal here is people have had lots of chances to make money off this. The bottom line is the fact that what's happening is by the time the people in New York figure out that this is worth doing, the bottom line is you need to wait because there's going to be a correction that you can buy. So that's something to think about. Euro dollar today is out there at 143.70, and pound sterling is trading at 163. The other thing that we have to relate to related to currencies, and we want to talk to people about this again and remind them, the deal is we've got a long-term forecast that says that pound sterling looks like it's going to be very capable to go to 2 pounds sterling to the dollar without trying too hard. So that's one of the things that you really need to keep an eye on. But the bottom line here is the fact that the worldwide basically demand, and I'm not talking industrial demand, I'm talking about a worldwide demand by small investors and large investors for precious metals is not going away, and these metals are not going down, especially when the dollar is going to hell in a handbasket. Now, as we all know, in this world, politics has a great effect on investment and money. And there are people out there who basically have managed to get themselves elected to office, who basically kind of typify what's wrong with the perception of how government is not accountable for what it does and not accountable for the money it spends and not accountable for anything else. And one of the classic examples of somebody who basically is probably the single greatest threat to the American taxpayer at the moment is a guy by the name of James Clyburn of South Carolina. He is a member of the Democratic leadership. He came out today in an article and said basically that Obama should veto any House resolution or any bill related to a short-term extension of debt, and that he should invoke the 14th Amendment, which says that the validity of the nation's public debt shall not be questioned. Now, this guy is a major bonehead, and there is no other way to explain it than that. This guy's in a situation where he does not understand the debt. He doesn't care about the debt. It doesn't matter to him. And he doesn't understand the implications of what it means to just blindly go down that road and just do whatever you want and wait to see what happens. The post-Civil War 14th Amendment, guaranteeing citizenship to all people or naturalized in the United States, contains a provision that the validity of public debt of the United States authorized by law, including debts incurred by payment of pensions, bounties for services, and suppressing insurrection, rebellion, shall not be questioned. Here's a guy who is in the House of Representatives, and this guy is blatantly misstating a physical fact that comes from an amendment. And this is the kind of dangerous dialogue that's happening out there because these people don't want to be held accountable. I published a very good article that has been getting enormous amounts of traffic, and this article basically will help the public understand what's really going on related to the deficit. Most people don't know what the deficit is. They don't know where it comes from or how it physically functions. And this article can be found at the examiner.com in the LA edition in the business section. The title of the article is called The Truth of the Deficit, and it's very important that you take the time to read it, but I will go through a couple highlights here and remind you of what's really going on. One of the biggest issues here is that most people don't understand. They think that this debt just kind of popped up out of nowhere. What they don't understand that is in the last 51 years, the U.S. government has never repaid a single cent of any debt that it has created or incurred. The other thing is that the majority of that debt are entitlement programs. Entitlement programs are situations where you've got basically federal employees, you've got federal pensions, you've got programs that have been funded that can never be shut off for some crazy reason. The last actual year that there was any decrease in the debt year over year actually occurred back in 1960. And you have to understand that the vast majority of federal debt right now, basically almost 97.5% of it, is debt that's been accumulating since 1971. Now, under the Carter administration in 79, basically the U.S. government went into a default situation because of the debt ceiling. The bottom line is they got it straightened out. The deal is the fact that the current accumulating process was started on the Bretton Woods Agreement, which was ended by Richard Nixon when he took the country off the gold standard and basically eliminated things like silver certificates and that type of thing. People have to understand that the federal government by both parties has been dodging, dealing with, and paying down debt for 50 years. And so right now, about 50 cents of every penny that we spend is actually borrowed money. We would actually have to physically cut federal spending by 50% to just freeze the deficit where it is right now, just so that we could service it. One of the real big problems here is the fact that every government official, every elected official, every appointed official, every federal employee somehow or another thinks that they are basically, and they pretty much are, they're on the proverbial golden gravy train. They can't get fired, they can't get laid off. You've got Congress voting itself 29 and 30% pay hikes every time there's a president that gets elected. And remember, that's a 29 to 30% pay hike for their pension funds as well. The thing is the fact that we have to look at the fact that right now the Democratic majority has allowed the debt just in the last 3 years to grow to $1.5 trillion each year. It's growing by $1.5 trillion each year during the last 3 years. I mean, this is unheard of. This is more than the history of the country. So the thing is that the new deficit reduction program was originally targeted at $4 trillion down to $2 trillion. The bottom line is that's not going to get done either, and that would take over 10 years to produce. The bottom line is the fact that it will allow the debt ceiling for another $2.4 trillion. The increase in the $2.4 trillion will only cover the federal government funds until the next presidential election. The bottom line, this is stopgap financing. The country, in essence, is bankrupt. It's broke. It's living on borrowed money, and everybody who's in Washington is getting paid off money that's been borrowed. This is one of the real problems, is that the federal government is the single largest piece of worthless overhead that we have. And the bottom line is the more you raise taxes, the more you slow the economy. The more you raise taxes, the more you kill jobs. The bottom line is right now is that the people in the federal government think that if they create these phony federal jobs for a phony federal agency, they don't seem to understand it does not contribute to the gross national product of the country. So we've got some real issues here that have to be dealt with. And the bottom line is the fact that we do have aristocrats in this country, and the bottom line is they're federal, state, and public employees who are basically getting a free ride and giving themselves enormous pay raises. That's why, as an example, in the city of Newport Beach, we have some lifeguards that get $200,000 a year. I mean, this is totally out of control. So what we have to look at here is the fact that there is an across-the-board problem with the fact that both the media, which is basically controlled out of New York and manipulated by some major East Coast publications, they are basically not giving the public the straight scoop. They're not telling them the whole truth and nothing but the truth. What they're doing is they're only telling them what they want you to hear in order to try and manipulate you to go in some other directions. So the problem here is the fact that we've got people saying, I think there might be a second recession coming. The reality is it's not a second recession. The original recession never ended. There never was a recovery. You can't have a recovery when you have growing unemployment, decreasing jobs, more people on poverty, more people making less money. One of the really fascinating things that a lot of people don't seem to quite get a handle on is the fact that when we look at wages, private sector wages are at an all-time low for people who work in the private sector economy. Wages for people who are federal government employees are at an all-time high and going up higher every day. One of the easiest things to do to try and help solve the deficit would be to eliminate all foreign aid. Cut it completely. The United States government pays for everything that goes on in terms of supporting the cost of keeping the UN in New York. They could cut and eliminate that funding and let the UN pay for its own situation. Of course, that would cause all kinds of screaming and yelling. The other thing is the fact that we could make all federal employees take a wage rollback to 2003. And the other thing we could do is we could lay off federal employees that have been hired since 2003. This is one of the big issues. If you cut spending to equal your revenues, the bottom line is you'll have a balanced budget. The bottom line is that the people in Washington don't want to do it. They will not do it. They'll do everything they can but do it, and they're willing to let the country fall in the street and go bankrupt for their own political gain and for own personal benefit. So you've got to pay attention to the fact that the stock market is highly unstable. It's very dangerous. The Treasury market is extremely dangerous at this time. So you've got to be very, very careful about what you do. And what we're telling people is the fact that they need to pay attention to the fact that there are a lot of issues out here. And there are some classic examples of how you know things are really off the chart in terms of perception of what's going on out there. Because one of the best examples is there's a magazine on the East Coast, which is about as far left as the magazine can be. That magazine is known as The Atlantic. In fact, the joke about The Atlantic is they have a corporate jet, but it only has 2 left wings. Today, there was an article talking about the fact that The Atlantic is talking about the 10 best investments in the event that you have a U.S. default or downgrade of the dollar. And the bottom line is they started out by saying, well, you should go into international bond funds. Why? Because the bottom line is those bond funds are all involved with everything outside the United States. The next thing you should take a look at doing is getting involved with Canadian funds. Because why? It's in Canadian dollars. It's not in U.S. dollars. It's in Canadian investments. The next thing you should look at is the Singapore iShares on the MSCI index funds. Once again, everything outside the U.S. because it's not involved or affected by the U.S. dollar. Now, the really funny thing here is the fact that here is an incredibly left-wing publication that is virtually anti-everything. And it's so institutional. I mean, these guys, basically, they need to carry a copy of Chairman Mao's Little Red Book. But their 7th best investment that they're suggesting is they're suggesting that everybody get involved with gold and silver ETFs. Okay? All right. They also, as the 6th best investment, are saying you should just go out and buy physical silver. All right? Now we're down to the fact that they're talking about buying AAA corporate bonds. Okay? If you're going to buy corporate paper, you can only buy corporate paper from people who have outperforming earnings, outperforming stocks. So the bottom line is, you know what? If you want to buy corporate paper from Apple, that sounds pretty good. If you want to buy corporate paper from people like ExxonMobil or Johnson & Johnson or Microsoft, those are all relatively good things to do. You notice that none of these things involve with getting into any of the other things. Here's an example of how completely behind the curve and clueless these people are. After the massive run in the Swiss franc, these people are telling you out to physically go out and buy physical Swiss franc currency because they've now figured out that guess what? The Swiss franc is appreciating against the dollar. And they are figuring out that maybe the dollar is going to continue to decline in value. But they're going to have you do this, quote unquote, when you could have done it a long time ago. And of course, needless to say, where were these people 6 years ago? You know, where they were? They were all hiding at a cocktail party. The last thing that they're suggesting, which is the worst thing you can do right now, is to buy T-bills. That's absolutely a disaster to do. But of course, these guys don't know anything. They're busy at a cocktail party, and they're all being terribly friendly and sophisticated, but they actually don't know anything. Their 2nd best investment is that you should buy physical gold. Okay? And the thing that's totally hilarious now is they're telling that you should buy basically stocks that have dividends and cash balances. The bottom line is for the last several years, everything you got from Wall Street is don't buy any stock that yields a dividend. They don't have enough growth. They're not going up enough. The bottom line is basically the entire country has been basically led to the slaughter by Wall Street and the federal government. Bad choices, bad recommendations, phony forecasts for business development and business growth. And the bottom line here is the fact that what you have to do now is you have to realize that you cannot afford to lose money anymore. So the thing of it is that all the things that they told you not to invest in years ago, now all of a sudden they're coming back and saying, oh, guess what? Oh, I think maybe you need to think about this. The bottom line is you have to ask yourself, if it's such a good deal, why is the brokerage firm selling it to you? Because in reality, if it's that good a deal, they're going to keep the position. If you look at these IPOs are extremely risky. In many cases, after 2 to 3 months, they're down well below their initial offering levels. And the deal here is basically Wall Street is pretty much turning once again into the gambling casino of the world. So you have to keep your eye on the ball. You've got to keep very focused on what you're doing. And the bottom line is you have to diversify your risk, but you really have to know everything about the company that you're going to get involved with. The other thing to remember is you have to trade or you're going to die. The bottom line is you cannot own things forever. You cannot own things blindly. You have to buy them at a certain level. You have to hold them to a certain level. You have to take a profit. You have to get out. You have to put that money in the bank. And right now, the bottom line is the fact that owning things in dollar denominations is a bad move. So the bottom line is the fact that when you own precious metals, you're currency neutral. You can get involved in other funds outside the country, and you can do this, and you're in another currency, which will protect you. But the bottom line is anything you have in dollars is basically now at extreme risk, and you cannot count on the U.S. government. You cannot count on the Federal Reserve, and you definitely cannot count on Wall Street to look out for you in your best interest. So once again, this has been the Shadow Podcast for July 27th on Wednesday. And remember, trade or die.